Hello, everybody. My name is Jeff Fowler. I'm the president of the Apartment Owners Association. It is great to have you with us today. And AOA, we've been around for over 40 years. We're dedicated to your real estate success and just trying to bring you different ideas that'll either help you save more money or maybe money-making ideas that will help increase your your profit totally. And so anyway, today we're talking about DSTs. And before we get into that, I did just want to mention we do have a special right now, and we do have a lot of people that are doing the rent reporting, and we are trying to sign up about 200 people, 200 residents. And so we're going to do a deal where we're going to give away an Amazon gift card to the first 200 that we get to sign up. And so if you're using AOA's property management software, the Property Manager Cloud, you opt in, and then when the renters opt in and when they're set up, we're going to be giving them a $10 gift card. And yeah, because what we've seen is that the renters aren't really interested, but it's this law for people who have 15 units or more where they need to offer the rent reporting. And anyway, so that's one special thing that's going on right now. And tell your friends if you have other friends that have uh, that fall under that ordinance where they need to, by law, they need to at least offer it by April 1st. So here we are in March, and we're gunning for that one. All right, so we do have the trade show coming up next month, and it's going to be April 16th. You may have gotten an email or a text about that just earlier this week. And so you register for that. It's free for your friends. So invite your friends to come along. And we are doing a food drive with that. So bring a can of food, and we will get that to people who will be able to make a difference. And anyway, so that should be great. And your friends, if they don't have a membership with AOA, never have had one, then they do get a free 6-month membership. So that'll be cool for the trade show. And you guys know there's so many vendors and so many good seminars going on. So that'll be really, it's worth the time to carve out a day and sharpen the axe. So just want to invite you to that. All right. And for those of you that are new, there is a blue, if you're watching from AOAUSA.com, there's a little blue help button on the bottom right side of the screen. You will be able to type in questions there, and they'll get those questions over to me, and then we can ask our speaker. And so we just a shout out to 1031 Capital Solutions for making this event possible. And our speaker today is the managing partner, and he is the author of How to Retire from Being a Landlord. He's a UCLA graduate and the grandson of Prop 13 author Paul Gann. He has extensive experience in real estate taxation and investment syndication. With securities licenses since 2003, he brings deep expertise to 1031 qualified investment programs. And anyway, so it's really my pleasure to bring on attorney Richard Gann.
Thank you so much, Jeff. I appreciate the opportunity to be joining you again at AOA. I've been able to participate in multiple events in recent months, and it's really gratifying to get to spend time with AOA members. Again, my name is Rick Gann with 1031 Capital Solutions. And my goal for this webinar today is to answer the question on your screen: can you exchange your rental property for a better lifestyle? And of course, I think the answer is yes. And I hope you will feel the same as we get through this information. Before we get too much further along, I have a few disclaimers and disclosures to share with you. This presentation is not a solicitation. Real estate securities are not suitable for all investors. Risks of investing in real estate securities are no less than the risks of traditional real estate. Investment programs typically have higher fees than traditional real estate. Mineral rights, which we'll talk about briefly, are highly sensitive to energy prices. And although the name of our firm is 1031 Capital Solutions. We do not give tax or legal advice. Before we get too serious, let me start off with an actual Jeopardy question that aired on January 7th, 2022. That's when Amy Schneider became the fifth Jeopardy millionaire on that particular night. And the question is, Paul Gann and Howard Jarvis led a revolt against these taxes that upset many Californians with big jumps every October. The category was, it's the 1970s, man. And of course, the answer is property taxes. And I bring this up because when you grow up as the grandson of a tax crusader in the 1970s, you end up knowing more about property taxation than any child should have to know. And it's no shock that when I graduated from law school 28 years ago, that I went into the field of real estate taxation. That's been the theme of my career. And ever since then, whether it was in practice or in business, the overriding theme of my work has been helping property owners overcome the burdens of real estate taxation. A little bit more about us. As Jeff mentioned, a few years ago, we wrote this book, How to Retire from Being a Landlord, which you can order on Amazon, but you can get it for free if you go to our website. And our website is 1031capitalsolutions.com. You can order the book for free. We're happy to send that to you right away. Our firm, in a nutshell, our purpose is to help folks who own rental properties retire from being a landlord. And we've got offices in San Diego, in Sacramento, and Seattle. I split my time between Seattle and Palm Springs. And then we've got advisors in LA, in Denver, and Portland. And our team, which is my business partner and the 5 other advisors that are part of our team. So there's 7 of us actually up and down the West Coast working with folks just like you. Our team over the last 6 months has sold about $75 million of real estate. So far this year, our little group represents just shy of 3% market share for the entire United States of passive replacement programs. So I bring that up because this is not only what we do, it's all we do. We are experts in this field. And if you have any interest whatsoever in taking a look at replacing your rental property with a passive replacement opportunity that we're going to talk about today, please consider 1031 Capital Solutions as your go-to resource. Today's discussion is going to center around 3 themes. One, probably the most obvious, is the reasons that folks today who own rental properties are considering selling those properties. Secondly, some of the fears and concerns people have about selling their rental properties. And then, of course, the solutions that we ultimately have for you to address those needs and concerns. When I'm doing this seminar live, or often doing a dinner or lunch seminar, I will pass out these slips, and I'll ask people to complete the sentence, "One time one of my tenants ... And as you can imagine, I get all kinds of crazy answers from folks answering this question. And the point of the exercise is really, rather than me telling folks any horror stories that I've had as a landlord, or telling you, it's fun to hear from everybody sharing. And so I just pulled randomly 3 slips from a dinner seminar that I did last week. And one time one of my tenants installed security cameras without my knowledge. And when I was over there to clean the roof, the SWAT team showed up. Another one time one of my tenants didn't clean the bathroom for 5 years.
Oh,
And finally, one time one of my tenants used some fence posts, oven racks, and aluminum foil pans to build a barbecue on our patio. Anyway, I have boxes of these slips, and some of them are R-rated. I couldn't even share with you over a Zoom call, But my point is, everyone who owns rental property at some point has crazy stories regarding their tenants. But it doesn't stop there. People also today are considering selling because of maintenance hassles, because of the increasing threat of legal liability, particularly if you're a landowner in anywhere in a state within the Ninth Circuit. Dealing with mold abatement liability, looming capital expenditures, screening regulations that are becoming more onerous than in some places where city councils have passed rules to prevent landlords from even doing background checks on their prospective clients. The restrictions on deposits, of course, rent caps, the eviction procedures becoming so Byzantine, and then of course the just cause tenant removal requirements that started statewide in Oregon and then California adopted statewide. So, a long and growing list of reasons that are making it more and more difficult to simply be a rental housing provider on the West Coast. But then there are some macro issues as well. You may own rental property in an area where the demographics are no longer favorable, meaning that more people are moving out than moving in. You could be in an area most likely where taxes are continuing to go up rather than down, which is likely the case on the West Coast. And also, you may own rental property where there are economic challenges in terms of job growth, or maybe in an area where big companies have been moving their headquarters or their manufacturing facilities away from where your property is and moving to more business-friendly, tax-friendly states like Texas, for example. So the issues that we're all facing as rental housing providers on the West Coast, aren't always necessarily limited to what's happening at the property level. It's also macroeconomic and demographic. But the most compelling reason to me to consider selling your rental property is that particular property may no longer generate the yield necessary to justify the hassle and liability of being a rental housing provider on the West Coast. And the reason that this is so important is so many people, I suppose it's human nature, tend to think of their net income today that they're receiving from their rental property as a percentage of what they paid for that property 10, 15, 20 years ago. And the truth is, that's just not the right way to look at your investment. When you're thinking about the financial health of any real estate investment, but in particular, property that you own and manage and roll up your sleeves and work on every day or week or month, you really need to think on an ongoing basis. Today, based on the equity in my property, is the yield that I'm getting as a percentage of that equity, does that still justify the hassle and liability of owning this particular property? Or is it time to perhaps sell that property and relocate that equity somewhere else into some other property, not across town, but some other property, perhaps in a different state or even region of the country, where you can yield a higher cash flow relative to the equity in that property. This is particularly noticeable when you have owned a single family residence or townhome or condo that in all likelihood has appreciated over the last 10, 15, 20 years at a pace that's probably 2, 3, or even 4 times the pace of your rental income, meaning that your rent growth may have been steady over the last 20 years of owning a property, but the actual value of that single family residence, townhome, or condo could have gone up at a pace 2, 3, or 4 times faster than your rent growth. Not a bad thing, by the way. Obviously, that results in appreciation in that real estate. But what you end up with is dead equity, because now the equity in that real estate is no longer generating a sufficient yield. And today we have an arbitrage opportunity on the West Coast to sell your rental property, especially if it's a single family residence condo or townhome, to sell that property at a price that's much higher for a prospective owner occupier than it would be for a prospective rental property owner investor. Meaning, the property that you own today is worth more to somebody who's looking to buy a home where there's no inventory to live in, as opposed to someone who's looking to buy that property and continue to rent it out. And so there you have an opportunity to cash out and to, in an exchange, relocate that equity into a property that's going to generate a higher yield. And to make that decision, to make an educated choice of whether to keep or sell or exchange a rental property, and in particular, a rental property that could be sold to an owner occupier, we have tools for that. We have proprietary software at 1031 Capital Solutions to conduct a property cash flow analysis for you. It's a 15-minute phone call with information that you have in the top of your head. And I or one of my team members can walk you through on a Zoom call in real time, gather information with you, and generate a report that looks exactly like this to tell you what is the financial health of your real estate, and specifically, what is the yield that you're getting today on your equity when you factor in all the revenues and expenses and certain costs that you may have forgotten to account for, forgotten to attribute to your real estate, future vacancy, turnover costs, capital expenditures, etc. So we are happy. This is a free service. And if you're interested in getting a health check on your rental property, please let us know, and we'd be happy to schedule a call and walk through the property cash flow analysis with you. So we've identified, lots of reasons for any rational person to consider selling their rental property. And yet, despite all those reasons, I talk to people literally on a daily basis who, half of their brain wants to sell their property and the other half of their brain is preventing them from doing so. And why is that happening? And so I put together this slide to really just to illustrate the most common categories of reasons that have been articulated to me over recent years. The first of which is our property value or rent revenue could continue to grow and we'll miss out on the great opportunity. And this is a natural human inclination to look back at the history of the appreciation in a rental property and want to project that going forward. And I think for a lot of you in the audience, and the same applies to me and property I own, the conditions that allowed for the appreciation that we've enjoyed in our West Coast real estate over the last 10, 15 years, in many cases, is not going to continue to be there for us to generate continued appreciation over the next 10, 15 years. Things have changed. We're seeing now that more people are moving out of California than moving in. The population of the state of California as a percentage of the country is dropping, and they're losing congressional seats. We're seeing other markets on the West Coast with population decline. And so there's a supply-demand change, as well as this major shift in terms of business friendliness, the anti-landlord environment, et cetera, et cetera. And it's hard to believe that the economic conditions and the demographic conditions that drove all of our property values for the last 10, 15 years on the West Coast will continue to provide that growth over the coming decades. And so you have to let yourself think forward instead of backward in making a decision to hold on to your rental property. Another example, I won't be able to find another property. That's a very rational concern, and we'll talk about how we address that. Another, I don't want or can't get another loan. We're going to touch on the 1031 rules, the requirement to replace debt, and talk about how there are replacement programs that allow you to to replace the debt on the property that you intend to sell without needing to actually go out and get a loan. Then there's good old-fashioned procrastination. There may be no real rational reason whatsoever to delay wanting to sell a rental property other than just not wanting to get around to go through the process of selling. And I get that, but that's not a good reason to continue getting a 1.5% yield on your equity. And then finally, capital gains taxes. People that I talk to there's a whole spectrum of understanding and knowledge about the impact of selling highly appreciated real estate. I think most people know that they're subject to considerable capital gains taxes, and then they have some inkling that there could be a way to mitigate that, but they're not sure. And so it's that lack of confident understanding that often is paralyzing and will cause people to not sell their property because they're afraid of the taxes. So let's take a moment to address the tax bomb that is facing anyone who is going to sell highly appreciated real estate. And it starts with just a quick illustration here of a property that was acquired for $500,000. We're going to call this a rental condo. And this rental condo over 10 years appreciated 3% per year. And so 3% times 10 years on a straight line basis is 30% appreciation. And so net of sales costs, this rental condo is sold 10 years later for $650,000. A very conservative example, of course. And most of our clients have had much greater appreciation over the last 10 years than 30%. But even in this conservative example, I think most people understand that they would be subject to capital gains taxes. And that's a combination of the capital gains tax plus the NIIT tax of 23.8%. And so most people intuitively would understand, okay, I've had $150,000 of appreciation, and so I'm likely to pay 23.8% capital gains tax on that appreciation. And you can stop there, and that would be a meaningful number. However, a lot of people forget about the depreciation, because over that same 10-year period, you or your accountant have been claiming a deduction for the quote depreciation of your real estate over that 10-year period. And for those of you that own residential real estate and are rental housing providers, you probably know that the IRS designated useful life period of a residential property is 27 and a half years. And so you divide each year by 27 and a half to calculate your depreciation. In this case, it's a condo, there's no land value. And so the annual depreciation is $500,000 divided by 27 and a half, which is also 3.64%. And so over 10 years, you've depreciated the value of your condo by 36.4%. And that adds up to $182,000 of depreciation. Well, if you sell your property and don't do a 1031 exchange, not only do you have to pay tax on the appreciation of the property, but also you have to recapture all of the depreciation you claimed over that time, because the IRS wants its money back for giving that deduction over 10 years. So you actually have a $332,000 difference between what's called the cost basis of your property and the sale price. So you're not just taxed on $150,000 in this example, you're taxed on $332,000. And by the time you throw in state tax on the West Coast, you're looking at $100,000 of tax on $150,000 of gain. And if you've heard me speak before, you've heard me mention that that 3% per year appreciation sounds a lot like another major macroeconomic metric that we're all familiar with, which is inflation. And so what you're really paying a tax on is just merely the inflationary increase in the value of your property. In terms of the real value, you didn't actually make any money on the sale of this property, because $650,000 is just what $500,000 is worth 10 years later based on inflation. It's an incredibly egregious tax. And in this case, this is a mild example of a conservatively appreciated property. Most of the scenarios we're dealing with involve much higher taxes on the sale. And so there's good reason to fear taxes if you aren't aware of the solutions that are available to mitigate those taxes. And of course, uh, what we're talking about is doing a 1031 exchange of your rental property so that you can avoid those taxes altogether. And this is not intended to be a 1031 exchange seminar. I could spend an hour just talking about 1031 exchanges, but the basics of a 1031 exchange, as I think most of you know by now, are that if you sell an appreciated rental or business property, in other words, a property that's been held for investment purposes, and then you replace that property with another investment property within specified deadlines, then you can defer all of the capital gains tax that you would have otherwise paid, especially if you have achieved what I call a complete exchange, meaning that you have replaced the full value of your rental property with some either a single or combination of multiple replacement properties. The basics of a 1031 exchange we can walk through in a basic quiz. And so I like to do this just to get people thinking about these rules, and you can check yourself on whether you're familiar with the fundamentals of a 1031 exchange. But let me quickly walk through. In a complete 1031 exchange, you can defer all of what type of taxes you would otherwise have to pay. And of course, we're talking about capital gains taxes. When you conduct a 1031 exchange, all proceeds of the sale must go directly from escrow 2A, qualified intermediary, which is a specialized escrow function that holds the proceeds of your sale in 1031 exchange. After you close escrow on your relinquished property, you have 45 days to identify your replacement property. Similarly, after you close escrow on your relinquished property, you have 180 days to complete the purchase of your replacement property. Both those days, those deadlines start on the day you closed the sale of your rental property. To successfully defer all taxes in a 1031 exchange, you must replace the entire value of your rental property. This means replacing all of your equity and all of your debt. Like I said, to defer all your taxes, you have to replace the entire value of whatever you sold. And since 2018, 1031 exchanges are available only for real estate investments. So when we talk about doing a 1031 exchange into a passive replacement program, what we mean is a program that is designed for folks who want to go from being an active owner operator of their real estate, like everyone on this call, to being an investor in a passive program, a passive replacement program that qualifies for a 1031 exchange, where some large institution, often that manages billions of dollars of real estate, is operating the property that you've invested in, and that your participation in that property is so passive that that investment is called is subject to securities laws, and therefore you have to be an accredited investor, which requires that you either meet an income or asset test. The vast majority of people who own rental properties are automatically accredited investors by virtue of the real estate that they own. But these are investments that are both real estate and securities because of the passive nature of your participation in the investment. We call them replacement properties because they qualify as real estate going in and coming out of the exchange, meaning you can do a 1031 exchange into one of these replacement programs, later sell that or participate in the sale of that property, and do another 1031 exchange into other real estate. And finally, we call it a program because these are pooled or fractional interests in a property where you are not on title, where although you are treated as having a fractional interest, you do not have direct ownership in the underlying property. The underlying property is owned by by a structure of which you are a beneficial owner. Did we mention passive? Passive means there's no searching, negotiating, or worrying about closing on the property that you're investing in a 1031 exchange. You don't have to worry about seeking tenants. You're not worrying about screening, leasing, deposits, rent collections. You're not responsible for any maintenance expenses and bills. No property tax or insurance payments, no legal liability or evictions concerns. You are along for the ride and no longer participating in any meaningful way in the operation of the underlying real estate. Also, these programs have built-in non-recourse financing. And going back to the earlier concern about folks who are afraid to sell their rental property because they know that they have to replace the loan on that property if they want to do a 1031 exchange under the IRS rules, these programs have loans that are already built into the program that already exist before the first investors walk in the door. And so you are able to essentially be assigned your pro rata share of the financing that's already on that property without qualifying for a loan, without applying for a loan. The bank doesn't even know who you are. You're not a party to the loan agreement. There's no personal recourse liability to you. You don't have any payment responsibilities. You're not getting in front of a notary signing documents. There's no public record of your association with this debt, and the debt on the property you sold is no longer on your credit report. And yet, despite all of that, you get to take credit for that debt for purposes of replacing the whatever loan you had on the property you sold. And for those of you who don't have a loan on your rental property, this doesn't apply, and you don't have to worry about this requirement. But for many of our clients, they typically have some loan on the rental property that they're selling, and the ability to replace that debt without having to barely lift a finger to receive an allocation of that existing financing is a tremendous benefit and an attractive element of these passive replacement programs. The first example I will touch on are DSTs, Delaware Statutory Trusts. The Delaware Statutory Trust is the most common today form of passive replacement programs. A Delaware Statutory Trust is just what it sounds like. It's a property that is owned by a trust that was formed in the state of Delaware. Now that's as complicated as it gets. You are investing in real estate, but that real estate on title is owned by a trust, a Delaware Statutory Trust. There are typically 1 to 3 properties in a DST program, although there can be as many as 30, but usually 1 to 3. They can have anywhere from $25 to $250 million. There's a DST out right now that has $450 million worth of real estate in the DST. So there are some whopper DST programs that will raise capital for months from investors just like you. The typical minimum investment, however, despite the large sizes of these portfolios, is typically $100,000, maybe as high as $500,000. But that flexibility allows us, even for someone that sold a $500,000 property, I could put you into 3 or 4 DST programs and create a little mini portfolio of real estate to replace your rental property. The most popular sectors are apartments, industrial, and self-storage. Class A apartment communities are typically half of all the DST offerings that we see. And no surprise, most of these programs, the properties are not on the West Coast. They're located in the Southeast, in Texas, the Southwest, states that are tax-friendly, business-friendly, and landlord-friendly, places where people are moving to, places where jobs are being created. Those are the most popular locations for these programs. The typical hold period for a DST program is 5 to 10 years. The average is about 6 to 7. And of course, there's no liquidity during that period. You are investing as a fractional owner in a portfolio of real estate. And so you are along for the ride, and your liquidity opportunity comes when the sponsor sells that property, again, on an average of 6 to 7 years after you invested. Some of the programs do not have any debt on them by design, but the ones that do typically have 30 to 55% leverage on those on the property value. The typical yield is on the vast majority of these programs is between 4 and 6. I would say right now the first year yield, meaning the amount of money that's going to go into your pocket over the course of the year from 12 monthly distributions is typically 4.5% of the equity that you invested in the program. But as I mentioned earlier, for clients that we do a cash flow analysis on their current property, and it turns out that they're getting 1.5 or 2% yield on their equity on their current rental property, even with a conservative 4% yield on a DST program, we are routinely doubling the income of our clients on their dollars, on their equity, because of the fact that their equity is just so high on their rental property that a 4% yield is twice the yield they're getting now. So there's a lot of opportunity for a lot of our clients to enhance your income, even going into a conservative DST program. And like I mentioned, most of the distributions are monthly, going directly into your checking account, although some are paid quarterly. Now, I can spend 6 hours talking about DSTs. I just covered it in a few minutes, but that is the first category and the most popular type of program that we offer for folks doing a 1031 exchange to replace their self-operated rental property with a passive program. The second most popular is what we call a pre-REIT property. And this is a close cousin to the traditional DST. In a pre-REIT property, you are investing in a property that is ultimately going to be absorbed by a real estate investment trust. In fact, in most cases, it's a property that's already in a real estate investment trust or REIT. That the REIT sponsor has pulled that property out of the REIT, repackaged it to receive 1031 exchange dollars from investors like you, and then 2.5 years later, they'll reabsorb that property into the REIT, and all of the participants in that property are able to exchange their equity in that property for a corresponding interests in the operating partnership of the REIT. And that's called a 721 transfer or 721 exchange. And that's tax deferred just like a 1031 exchange. And so what you're essentially doing is you're doing a 1031 exchange today into a property with the intent of ultimately exchanging your interest in that property in this two-step process to own shares of a REIT down the road. And one of the advantages of investing ultimately in a real estate investment trust is that you have redemption features that allow you to call me up and say, hey, Rick, I need $100,000, and be able to pull cash out or redeem your interests from that REIT in a way that you can't do with other real estate. And so you get to enhance your liquidity potential. But frankly, most of our clients don't intend to pull cash out, although they like the fact that they're able to do that. The idea is to, whether you do a DST or a pre-REIT program and end up in a REIT, the idea is to hold those assets ultimately until you pass away, receive the step up in basis under tax rules, and then completely wipe away all of the deferred capital gains tax that otherwise would have been paid during your lifetime, so that your kids can liquidate those assets and be free of the capital gains tax burden that would otherwise follow those real estate investments. So whether you invest in a DST or a pre-REIT property, ultimately the idea is to combine 1031 exchanges with the step up in basis, what we call swap till you drop. I didn't make that up, but that's the phrase. And ultimately be able to not just defer, but avoid altogether the capital gains taxes that you'd otherwise pay. And then finally, we have a mineral rights program, a couple of these programs that are designed for folks who are looking for something a little bit more exotic and frankly, with a totally different risk profile than traditional real estate. These are programs that qualify for a 1031 exchange because mineral rights under federal law are still real estate for purposes of 1031 exchanges. But what you're really investing in ultimately is the right to receive royalties from folks who are drilling oil and gas on properties in Texas, Oklahoma, Pennsylvania, et cetera. And you own a basket of fractional interests in mineral rights across hundreds of parcels. And what you're receiving over time is an income stream with tax advantages that are related to the unique tax law associated with oil and gas drilling, but you're also exposing yourself to the oil and gas industry in a way that, of course, you wouldn't have in traditional real estate. Like I said, the best way to describe mineral rights as a 1031 solution is exotic. It is different. It's a different risk profile, but it is a very unique way to diversify away from the types of economic and other demographic risks that affect all real estate, and get into an area that's ultimately going to behave differently from both a financial and tax perspective than owning a fractional interest in an apartment community or a self-storage facility. So these are all just touching briefly on topics that I could spend hours on each slide. The purpose of today's webinar is to really share with you these concepts of being able to have truly passive ownership in a program that allows you to do a 1031 exchange, have institutional management of your assets, potentially have built-in non-recourse financing with the potential for income to preserve your capital, and to do all this in a way that avoids the escrows and other hassles of traditional real estate investment. General real estate risks apply to everything I talked about. There are no guarantees. These are illiquid with relatively long hold periods. The fees are more expensive than what you would pay if you went and bought your own real estate, and you do have to be accredited to invest in all the programs I've referenced today. But if anything I talked about today piqued your interest, then we would love to work with you. Please, if we aren't able to answer your questions today, reach out to us, give us a call, go on our website. You can schedule a call with me or my team at 1031capitalsolutions.com. The phone number is 800-445-5908. And with that, Jeff, hopefully you can take a few minutes to take a few Q&As.
Awesome. Thank you, Rick. Thank you for that. And yeah, so now if you have a question, definitely now is the time to put that in the chat on YouTube or Facebook. And then, yeah, we do have a couple here. And Arlene Kaiser, do you ever have people who don't need the 1031 but still exchange with you? So maybe she means that have cash maybe she means cash to invest. Is that possible? All right, are you guys able to hear me? Okay, we're getting used to a new program, so you may not be able to hear me right now.
Jeff, I can hear you now, but I think I was frozen for a minute.
Oh, you were just frozen. Okay. All right. So from Arlene, let me repeat the question. Do you ever have people who don't need the 1031 but still exchange with you? So maybe she means just invest, like 100,000 or something into one of the DSTs.
That's a great question. And the short answer is yes. We have had over the years folks who will invest in the programs that I've described to you outside the context of a 1031 exchange. And one of the advantages of investing cash in a DST as opposed to some limited partnership or LLC program is that you can actually 1031 exchange out. And one of the frustrating aspects for some people of investing in more typical syndicated programs like partnerships is that they'll have a good return potentially, but then when that partnership liquidates, then all of the investors have to pay tax on that return. Whereas if you invest cash in a DST program, then you can keep rolling those capital gains going forward and defer the gains. So yes, absolutely happy to talk to you about investing in these types of programs without needing to do a 1031 exchange.
Awesome. Okay, and we have James. Do you ever get a write-off with DST program?
Yes, when you do a 1031 exchange into any real estate, including DSTs, your depreciation schedule carries forward in your exchange. And so you continue to claim depreciation deductions, assuming you did not exhaust your depreciation on the property you sold. However, and this is really important, to the extent that you increase the amount of real estate that you now own in a DST because of the fact that there's greater leverage in the DST than what you sold, then any of that additional real estate that is attributable to your ownership in that DST, that is newly depreciable. And I point that out because many of our clients will experience a noticeable increase in their depreciation deductions after they do a 1031 exchange into a DST, not only because they've picked up some extra real estate through leverage, but also because these properties are typically in places where the land value is very low to the improvements. And so your LA property that you sold, 60% of that value could have been the land. And then I'll put you in a program where only 10% of the value is the land. And so now you've increased your depreciation deductions even more just by virtue of the location of the property. So absolutely, all of our folks who invest in DST programs get to participate in depreciation deductions.
All right, Chester Can on YouTube. My 1031 exit from a syndication. So if someone's is selling in a syndication, is that possible to do a 1031 exchange there?
Yeah. Again, it depends on the structure of what you invested. If you were previously invested in a tenant in common program, for example, which those were common in the early 2000s, most of the 1031 money went into TICs before the DSTs came about in 2004. If you were in a TIC or TIC program, then yes, you could roll out of that and do a 1031 exchange into one of the programs we've talked about. But if what you were invested in was an LLC or a limited partnership, then unfortunately, when they liquidate that program, you cannot 1031 exchange shares of a limited partnership or an LLC. That's just the nature of the 1031 rules. So it really depends on the structure.
Gotcha. What are the costs and fees associated with the DST?
Every DST follows essentially the same template. The sponsor is going to buy a property and then repackage it up as a DST and then resell it out into the marketplace, marked up from the price that they paid for it 6 weeks ago to its DST price. And that markup includes a few basic categories, which is the reserves that they have to set aside for future capital expenditures. It includes the syndication costs, which most of that is commissions paid to the broker dealers, the folks like us who sell these programs. There's the transactional costs associated with putting the deal together. And then fourth, there's the fees, the acquisition fees, which represent the profit of the sponsor. And even though those vary to some degree from deal to deal, those are the 4 categories of expenses that are built into the markup of a DST. When you invest in the DST, nothing comes off the top. If you put $1 million in a DST, your entire $1 million goes into that DST, and you are credited for $1 million investment. But you're still indirectly paying these expenses because these expenses have already been built in terms of the markup of the real estate. And the classic example that I always use is a $90 million Class A apartment building in a suburb of Jacksonville, Florida, that is now resold as a DST property for $100 million. That example is typical of what you would see in the difference between what the sponsor paid for that property 6 weeks ago and what the total price will be now for DST investors.
All right, Lintz on YouTube. Do apartment DSTs with leverage tend to have higher income estimates or lower?
Higher or lower what, Jeff? I'm sorry, I missed.
Income
Oh,
estimate.
income.
Yeah.
These days, you would think that there would be a significant difference between all things being equal, between the yield of programs that have no debt versus the programs that have debt. And the truth is, today, because the cost of debt has gone up, as we all know, that the programs that we see really all kind of have the same annual yield in the first year as a percentage of the equity. So the short answer is no. We used to see in the past, when the cost of debt was significantly lower, that you could lever up and you could juice the yield, as they say, on a highly levered program, because the cost of servicing the debt was relatively low, and so you could get a higher yield. But those numbers don't pencil out today, and so a DST that's 40% levered is not going to have a higher yield than that same property if it's all cash, because of the cost of debt. That will change over time, and when the interest rates come back down, hopefully sooner than later, then we'll start to see that spread open up and see a difference in the yields on those properties. That's probably more information than you wanted, but
No, I
that's
think
where we are.
that's great for answering the question, I think. In the chat, Olivia, regarding DSTs, why does the hold period typically end, and what happens to one's investment after that?
Sure. That it's no coincidence that the average lifetime interest only period on the loans of DSTs is 6 years, and that happens to also be the average hold period of DSTs historically. And the reason I say that is because most of the DSTs have debt on them, and because most of the time the interest only period ends around 6 years, the sponsors tend to want to sell the property before the end of the interest only period, at which point the loan, as you all know, will amortize. And once a loan amortizes, then the debt service gets larger, because now you're starting to pay down principal as part of your mortgage payment. Well, when you do that, the yield drops, because now the DST is having to pay more money to service the debt. And so the money that otherwise would have been paid out to the investors is now going to principal payments. And folks who are relying on that income get understandably grumpy when their distributions go down. So as a general rule, the sponsors will market the property as they're approaching the end of the interest only period and sell the property at that time. So that's where that average time period really comes from. When the property is sold, then you're in the same position that you're in now, which is you can either pay the taxes, you can invest in another DST, or you can go back to owning traditional real estate. The truth is, the vast majority of people just will roll into another DST, because they're not interested in going back to owning their own real estate, managing their own real estate. But sometimes people will pass away during that ownership period, and so it's now the kids who are inheriting that DST interest, and they'll cash out because they don't need to do another exchange, because the capital gains taxes have been wiped away. But honestly, the vast majority of people, once they invest in a DST, will keep rolling into DSTs until they pass away. That's really the strategy.
Like to even just to back up a little bit, I know certain real estate investors that make it a practice to sell at 5 or 6 years anyway, because they can just go to a bigger property. And when you do that a few times, what you end up with 25 years down the road is much more significant than just holding on to the duplex.
That's right.
So
The same principle applies. You bet.
it's that same principle, which is great. Okay, and then on YouTube, how do you exchange into these if in a multiple person corporation?
Yeah.
As a corporation, you would as you're set up, that entity would go into the DST.
That's right. And as Jeff knows, this is a subject that you could do a whole separate seminar on, which is how partnerships and corporations deal with multiple members, especially when someone wants to drop out. And there's basically, quickly, there's two general categories of strategy. Either if people want to separate in that group, you drop out and way in advance of separate ways, or you move forward in the exchange as a corporation, as an LLC, as a partnership, and then worry about breaking up after the fact. There are pros and cons to both, but most of the time, what we see with our clients is that whatever the ownership entity, if it was a corporation, by the time they're talking to us, it's too late to dissolve that entity going into the sale of what their rental property under 1031 rules. So they'll do the exchange and then come out the other side, own the DSTs or whatever they've invested in, and then worry about breaking up that entity in the future. If in your question you had no concern about dissolving the entity and you just want to know about entities in general, most of our clients are selling a property and buying their DST interest as an LLC, corporation, or a trust, some kind of entity. That's the norm. And if you own an LLC whose only asset was a rental property and you've sold that, you need to invest in the DST in the name of your LLC. But then later on, we typically will dissolve that entity and then rename that property into the individual names of the owners of that LLC, because you don't need that extra layer of liability protection that's already afforded to you by virtue of the DST investment. So happy to answer more detailed questions offline if you got questions about entities and DSTs, but it's a very entity-friendly investment.
Great. Chester on YouTube. What's the historical exit returns of these DSTs? Many of them
I wish I could rattle off a number, Jeff, of what is the historic. Well, let me say this, and I'm not trying to dodge the question, because there's the performance. These are all private placements, and there's no repository of information or data that has all of the returns of all DSTs historically. So literally no one knows the exact answer to your question. I will say this, though. The performance of the DST industry since its inception, when they really started raising capital around 2010, 2011 to today. So, it's a 14, 15-year history of the industry since DSTs were approved by the IRS in 2004, but didn't really start raising capital until after the Great Recession. In that 15-year period, the overall performance of DSTs that have gone full cycle is extraordinary. The problem with that statement is that 15-year history of DSTs up until about 2 years ago coincided with the greatest run-up in real estate values in the history of the United States. So it's not a fair segment of time to use as an example for the DST industry, because it was such a favorable environment to own and operate and sell real estate. So the returns have been excellent. Whether or not those returns will continue to maintain that level, I have to say is doubtful, because the next 15 years, as I said at the onset of this seminar, the next 15 years are not going to be as great as the last 15 years in terms of interest rates, capital markets, all of the things that drove those real estate values. So today, when a client is selling a property, investing in a DST, my objective for that client is, let's preserve your capital, let's get you a reliable income, and then let's look for the opportunity for appreciation maybe on the next round, when things have got back to normal and real estate values on average start ticking back up again like they did over the previous years.
Do the sponsor companies have a target? Usually it seems like they would have a target that they're trying to reach, not that that's a promise or, something that you can't expect any, like you have to temper your expectations, but do they have a target on what they're looking for before they sell?
Yes. Thank you, Jay. That's absolutely. Most of the sponsors have a track record. So they'll produce statistics on the track record for that sponsor. And then also included in every private placement memorandum for every offering are pro forma projections on how the sponsor of that DST is anticipating the cash flow projections over the life of that particular property or portfolio of properties. So when we drill down to, if I'm working with you and I'm making recommendations, part of that consideration is talking about the track record of the sponsor, and then specifically the potential returns for that particular property. And that's where we can really get into understanding not only prior performance but also projections for the future. It's just hard to make those types of assessments at the industry level because we just don't have the kind of data that you would have for for public companies like mutual funds or public REITs.
Yeah, that's a pretty thick report that you're getting from the sponsor company, huh?
That's right. The transparency of our industry is really incredible. There's far more information that you have at your disposal to understand the real estate that you're investing in a DST than you have when you go buy a rental property out on your own. It's a 300-page book. That's just the private placement memorandum. That doesn't include the thousands of pages of exhibits of all the transactional documents. But there's literally a 200 to 300-page book written for every DST offering with all of the details on the property, on the market, the risks, projections. It's just more information than you could absorb, frankly, about those properties. So people make very educated decisions on these deals.
All right, we'll take just a couple more questions here. We'll try to do a speed round. Raj asks, what are the risks involved with losing your money?
There are no guarantees. Like any real estate, when you invest in any of the programs I talked about today, there of course is the of risk of the income being reduced or suspended. There's even the risk of losing capital. I mean, thankfully, that's traditionally has not that risk has not resulted in anything other than very rare examples of negative returns on investment in the DST space to date. But of course, this is still real estate. There's nothing magical about the structure of a DST that immunizes that property from all of the real estate risks that are inherent in that particular property, whether it's packaged as a REIT or owned individually. So at the end of the day, you are buying real estate, and you're not buying shares of a fund. You are a fractional owner of that real estate, and as such, you will experience your pro rata share of the ups and downs of that real estate, including any appreciation or decline in value, when the property is sold.
Okay, Lintz again. Does your firm offer fee-only consultation services separate from the 1031 DST transaction commission?
We do. We are both a registered representative of the broker dealer and that operates on a transactional basis, and then we also operate as investment advisor representatives. So yes, we can make arrangements to provide advisory services if you're interested in that, as opposed to the more conventional transactional work that we do on these programs. So both ways to work with us depending on your needs.
All right, next question. Is it possible to go from a DST back to private ownership? And quick answer, yes on that.
Yes.
And waiting for the thing to come full cycle, obviously, is going to be the best way. Arlene, again, any DSTs for military veteran investors only?
I've never heard that question before. Honestly, we've never seen any DST programs that have any exclusions of any kind. But that's an interesting question. But no, I've never seen anything like that.
All right, and here's our last question. Raj, is there any guarantee of getting a minimum of 4% cash on cash? And I know you're going to say no for sure, but what's the range of on that move?
Right. By the way, that's a fair question. Again, there are no programs that offer any guarantees. However, there is a spectrum, as Jeff is suggesting. There's a spectrum of likely returns, and if you invest in a DST where the underlying real estate is a long-term triple net lease with a highly credit rated tenant. I'll give you the extreme example. We've done DSTs where the DST is an Amazon distribution center. And Amazon is the, depending on the day, first, second, third largest company in the world, is is going to pay the rent on that distribution center regardless of what happens. And so that's pretty close to being guaranteed, because you've got the financial strength of Amazon behind that lease. And in that example, you're giving up the opportunity for long-term appreciation, to have a very reliable stream of income. And so there are some programs where there's a trade-off between long-term appreciation and the relative reliability of the income. But again, at the end of the day, we don't use the G word to describe the distributions coming out of a DST.
Right. Hey, thank you so much. And also people they can invest into, when they exchange into a DST, there can be multiple investments that they spread that into to kind of reduce the risk, so to speak. I know Chester's just asking this question here, so I just thought I'd mention that to address that as we wrap up.
That's
But
right. We encourage diversification, and with $100,000 minimum, I can put you in multiple DSTs, even for a relatively low purchase amount.
Great. Well, Rick, thank you so much for sharing your expertise with us today. And it's been fun to see you, up at the Bay Area Landlording Power Conference and some of your associates down in San Diego last week. And so it's really been a pleasure, and we really appreciate you and just what you're able to provide for members that are looking into this.
You bet. Thank you. I look forward to future events, and all of you. Um, if we didn't get to your questions, or you have any lingering concerns, questions, please reach out, give us a call, go to our website. And Jeff, thank you so much for having me again. I look forward to the next opportunity.
All right. Thanks, everyone.